Right now, while most investors in America are focused on stock tickers and Fed headlines, a supply crisis is quietly unfolding on the other side of the world that could change everything for silver holders. And the crazy part is, almost nobody in Western financial media is paying attention to it. The warehouses are being drained. The futures market is flashing signals we haven't seen in over a decade. And the traders who bet against silver are now paying out of their own pockets, just to avoid delivering metal they promised, but simply don't have. This isn't a prediction about what might happen someday. This is happening right now, in real time, in China. And by the time the mainstream outlets finally catch up and start writing about it, the window this is creating for informed investors could already be closed. So, if you've been trying to figure out why silver has been moving the way it has, or if you're sitting on a position and wondering what comes next, stay with me, because what we're about to break down today could genuinely change how you see this market. Before we get into it, if you found your way to Element Axis and this is your first time here, do yourself a favor and hit that subscribe button right now. The work we put into these breakdowns takes serious time and research. And if you're going to be making decisions about your money, you deserve analysis that actually goes beneath the surface. Subscribe and turn on notifications so you don't miss what's coming next, because the story we're covering today is still developing and there will be more updates coming. And if you're already part of this community, thank you, genuinely. Every view, every comment, every share helps this channel reach people who need to hear this kind of information. Now, let's get into it. Let's start with the price action, because that's what everyone's been watching, and then we'll move into why the price action is actually the least important part of this story right now. Silver went on an extraordinary run earlier this year. We're talking about a move that shocked even the most bullish analysts. Prices surged more than 60% in just a matter of weeks, an absolutely breathtaking vertical climb that pushed silver to levels we hadn't seen before. And then, as these kinds of parabolic moves almost always do, it corrected hard. Prices came down fast, erasing a significant portion of those gains, and suddenly the narrative in the financial media shifted from silver is exploding higher to silver is crashing. The bubble is bursting. Retail investors got burned again. And that framing, while it makes for great headlines, is dangerously misleading if you're trying to understand what's actually going on. Because while everyone was focused on the drama of the price chart, something far more structurally significant was quietly unfolding in the warehouses and exchanges in China. And that's what we really need to talk about. China is the world's largest consumer of silver. Full stop. The scale of China's industrial appetite for this metal is almost impossible to overstate. When you think about the sheer volume of solar panels being manufactured there, the electronics production, the advanced manufacturing, the electric vehicles, and all the other industries that depend on silver as a critical input, you start to get a picture of a country that has an enormous, ongoing structural need for this metal. And right now, the supply of physical silver sitting in Chinese warehouses has dropped to levels we haven't seen in more than 10 years. The stockpiles at the major exchange-affiliated storage facilities have been drawn down to decade lows. That's not a minor development. That's a major flashing signal that something has changed in the physical market, and it has very real implications for where prices go from here. Now let me explain why this matters in a way that goes beyond just saying supply is tight. The way futures markets work, under normal, healthy conditions, contracts that settle further out in time trade at a premium over near-term contracts. If silver is trading at a certain price today and you want to lock in a price for delivery 6 months from now, you'd normally expect to pay a little bit more than the current price. That premium reflects the cost of storage, the cost of insurance, the time value of money. It's called contango, and it's the default natural state of a commodity market when supply is comfortable and readily available. When a market flips into the opposite condition, when near-term contracts trade at a premium to future contracts, that's called backwardation. And backwardation is the physical market sending a very clear, very urgent message. It's saying that people need this metal right now. They're willing to pay more for immediate delivery than they are for delivery months down the road. And the reason they're willing to do that is because they're not confident they'll be able to get the metal later. Backwardation tells you there's stress in the physical market. And right now in China, the backwardation in silver futures is at record levels. That's not a casual observation. That's a historic condition that market professionals pay very close attention to, because it almost always precedes significant price movements. Now here's the piece of this story that really caught my attention, and I want you to think about this carefully because it reveals something important about the state of the physical market. The traders and institutions who had sold silver futures short, meaning they had made bets that silver prices would fall, are now in an extremely uncomfortable position. They sold paper promises of silver delivery that they apparently cannot back up with actual physical metal. And so, rather than being forced to default on those delivery obligations, they are paying fees to the buyers on the other side of those trades to essentially defer or delay the delivery requirement. These short sellers are paying money out of their own pockets to avoid having to hand over physical silver. Why would any rational market participant do that? Because they don't have the metal. They can't deliver what they don't have. And rather than face the consequences of a full default, they're buying time, hoping the situation resolves itself. But physical supply crunches don't just resolve themselves overnight. They take time to work through, and during that process, the pressure on the market tends to build rather than dissipate. This is not how a well-supplied, comfortable market behaves. This is how a market behaves when it's under real, genuine strain. Drop a comment right now if you're currently holding silver or if you've been watching this market closely. I'd genuinely love to know where you're at with your own positioning and how you're thinking about everything we're discussing today. This community is at its best when we're having a real conversation, so don't just watch passively. Jump in. And if this is the kind of deep dive analysis that you find valuable, hit the like button. It genuinely helps more people find this content. Now, with all of that context established, let me bring it back to the big picture and explain the broader framework for understanding where silver is right now and where it might be headed. After that enormous run-up and the subsequent correction, the market is in what analysts are calling a consolidation phase. And I want to be very direct about what that means and what it doesn't mean. Consolidation does not mean the trend is over. It does not mean the bull case has been invalidated. What it means is that after a parabolic, almost vertical move, the market needs time to digest those gains. Positions need to be adjusted. Speculative excess needs to be worked off. And during that process, prices tend to chop around in a range, moving sideways with a lot of noise but not a lot of directional progress. It can be frustrating to watch. It can test your patience and your conviction. But it's a completely normal and healthy part of how markets develop after big moves. The range that market watchers are currently focused on as a potential floor for silver is somewhere in the zone of $70 to $80 per ounce. And what's significant about the behavior during this consolidation is that even as prices were pulling back hard from the highs, retail investor behavior did not break down. There wasn't a wave of panicked selling. There wasn't a mass exit from silver-related products. In fact, during the sharpest part of the decline, buyers started stepping in on that first significant leg down. That tells you something very important about the conviction level of people who are positioned in this market right now. When prices dip and buyers show up rather than panic sellers, it suggests the overall positioning is in relatively strong hands. Flows into silver products have actually remained positive for the year, despite all the turbulence. That's not a market people are abandoning. That's a market where serious, informed participants are staying positioned because they believe the fundamental story is intact. And the options market reinforces this picture. Open interest in silver options right now is heavily skewed toward calls, meaning bets on upside. Institutional traders and sophisticated market participants are not using this consolidation phase as an opportunity to exit their bullish positioning. They're maintaining it. Some are even adding. That positioning is a meaningful signal because these are entities with serious analytical resources who are telling you through their actions that they expect prices to move significantly higher at some point in the not-too-distant future. Let's zoom out even further because it's important to understand the historical context for how silver tends to behave within precious metals bull markets. Silver has a well-documented tendency to lag gold in the early stages of a rally. Gold tends to be the first to move, the first to establish new highs, the first to attract headlines, and then at some point money rotates into silver. And when that rotation happens, silver tends to move explosively, not gradually, not in a slow measured climb, but fast and vertical. Because silver is a much smaller market than gold. So when capital starts flowing in, the price impact is much more dramatic. It's like the difference between dropping a rock into the ocean versus dropping that same rock into a swimming pool. The splash is completely different depending on the size of the body of water. We saw exactly this dynamic play out earlier this year. Gold moved first, silver lagged, and then suddenly silver shot up over 60% and hit all-time highs. That's the classic pattern. And the consolidation we're in now doesn't mean the pattern is broken. It means we're in the part of the pattern that happens between the first explosive leg and the next one. And if history is any guide, that next leg, when it comes, could be just as dramatic or potentially even more so. Now, I want to talk about something that doesn't get enough attention, and that's the structural supply deficit that exists in this market, independent of any short-term price movement. For several years running, the global demand for silver has exceeded the global supply for mining. The world is consuming more silver than it's producing every single year. And the gap is being bridged by drawing down existing stockpiles. But stockpiles are finite. What we're seeing in China right now, with warehouses at decade lows and the physical market in severe backwardation, is a direct real-world manifestation of this structural deficit playing out in real time. The demand side is only getting stronger. Solar energy is probably the most significant new demand driver for silver that didn't exist on this scale even 15 years ago. Every solar panel requires silver. And the global build-out of solar capacity is happening at an extraordinary pace. Countries around the world are racing to install solar power as part of their energy transition strategies. And every single gigawatt of that capacity requires silver. The demand from this sector alone has fundamentally changed the supply-demand math for this metal. Then you have the electronics sector, which continues to grow as the world becomes more digitally connected. Silver is used in circuit boards, switches, and contacts in a vast array of applications where its electrical conductivity makes it essentially irreplaceable. Electric vehicles are another growing source of demand, containing significantly more silver than traditional combustion engine vehicles. And medical devices add another layer of stable, recession-resistant demand that grows steadily with global healthcare expansion. These are not cyclical sources of demand. These are structural, embedded, growing needs. And mine supply is simply not keeping pace. Share this video with someone you know who's watching what's happening in precious metals right now. This is the kind of analysis that most people aren't getting from mainstream financial media. It takes 2 seconds, and it genuinely matters for helping this content reach the people who need it. Silver also benefits from investment demand, and the drivers right now are substantial and probably not going away anytime soon. We live in a world characterized by significant geopolitical uncertainty. There are legitimate questions about the long-term reliability of the US dollar as the world's reserve currency. The trends around de-dollarization, meaning the movement by various countries to reduce their dependence on the dollar in trade and reserves, are real and ongoing. When countries that have historically held large dollar reserves decide to diversify, precious metals are often where that capital flows. And silver, as the more accessible and affordable cousin of gold, tends to benefit significantly when these macro trends are in play. So you have a powerful combination of growing industrial demand, a structural supply deficit, and investment demand supported by a macro environment full of uncertainty and geopolitical tension. These are multi-year structural forces, and they all point in the same direction. Now let's talk about the macro wildcard everyone is watching, and that's Federal Reserve policy. When interest rates are rising or expected to rise, it creates headwinds for precious metals because it increases the opportunity cost of holding a non-yielding asset like silver. When rates are falling or expected to fall, it acts as a significant tailwind. Right now, we're in a period of genuine uncertainty. Markets had been pricing in rate cuts, but economic data came in stronger than expected, and Fed officials floated the possibility that rates might stay higher for longer. That tension is one of the main reasons silver is consolidating rather than moving straight up. But in the longer term, the direction looks clearer. The United States is carrying a level of government debt that makes a prolonged period of high real rates very difficult to sustain. The math of debt service creates enormous fiscal pressure over time. Eventually, the Fed has to navigate toward lower rates simply because the alternative becomes untenable. And silver has historically responded very well to easing cycles. So while short-term uncertainty is creating this sideways, choppy environment, the longer-term setup remains compelling. I want to be very honest with you about something, because this channel is about genuine analysis, not hype. Silver is one of the most volatile, emotionally challenging assets you can own. It will test your patience in ways that most other investments simply don't. The corrections can be brutal. The consolidation phases can feel absolutely endless. And if you're not psychologically prepared for that, silver can hurt you even when your underlying thesis is correct. You can be completely right about the long-term fundamentals and still lose money if you're not disciplined about how you manage the volatility. So the framework you bring to owning silver matters enormously. There's an important distinction between two very different approaches to silver, and understanding which one you're following before you enter any position is critical. The first is as a long-term holder. You believe in the structural story. You're accumulating a position over time using dollar cost averaging, putting in a consistent amount at regular intervals regardless of what the price is doing, and you're willing to hold through the volatility because you're measuring your investment in years, not weeks. For most people in the 45-plus age group thinking about silver as part of a broader portfolio strategy, this is probably the more appropriate framework. The second approach is as an active trader. You're watching charts, managing positions actively, taking profits when they're there, cutting losses when you're wrong. This requires discipline, clear rules, and the ability to take losses without being thrown off your plan. The dangerous place to be is in the middle. You start as a long-term investor, but when the price drops significantly, you get the urge to act. You sell to cut the loss, planning to buy back lower. That impulse causes people to trade their long-term position at exactly the wrong time. They sell near the bottom, watch the price recover, then buy back in at higher levels, which is precisely the opposite of what a disciplined investor does. Know which game you're playing before you start, decide up front, and then stick to the rules that go with that approach. Let me walk you through a scenario worth thinking about carefully because it illustrates how the current consolidation could set up the next significant move. Imagine silver continues to consolidate through the summer months. The price chops around, generating a lot of noise, but not much directional movement. Most retail investors who were excited about silver during the initial run-up get bored and move on. The mainstream financial media stops writing about it. But underneath the surface, the physical market keeps developing. China's industrial economy keeps consuming silver. Solar manufacturing keeps running. Electronics production keeps running. All the industrial uses of silver keep drawing down available inventories. Short sellers who don't have metal keep paying deferral fees but don't solve the underlying supply problem. Every month that passes, the already thin global inventory of deliverable silver gets a little thinner. Then, at some point, something shifts the macro picture. Maybe the Fed signals clearly that rate cuts are coming. Maybe a geopolitical development drives fresh safe haven demand. Whatever the catalyst, when the market wakes up, it's going to discover that the physical supply picture has become even more acute than before. The consolidation didn't solve the supply problem, it made it worse. And when paper market demand and investment demand both reactivate simultaneously in an environment where physical inventory has been further depleted, you get the conditions for the next explosive leg higher, not a gradual climb. A fast vertical move that catches most people off guard because they weren't paying attention during the boring phase. The central thesis is straightforward. Silver has experienced a dramatic rise, followed by a dramatic correction, and is now in a consolidation phase being misread as a sign the bull market is over. In reality, the fundamental picture has not changed and in some ways has intensified. The physical market in China is under genuine stress with warehouse inventories at decade lows, record backwardation in futures prices, and short sellers paying fees to avoid deliveries they can't fulfill. The structural supply deficit continues. Industrial demand from solar, electronics, and EVs is growing and shows no signs of slowing. Investment demand is supported by geopolitical uncertainty and questions about long-term currency stability. Retail investor behavior has been disciplined and patient. Institutional options market positioning is overwhelmingly oriented toward upside. And the Federal Reserve, while uncertain in the short term, points toward eventual easing that would be a significant tailwind for precious metals. The danger for most people is not that the thesis is wrong. The danger is that they run out of patience during the boring consolidation phase before the thesis has a chance to play out. Markets are specifically designed to shake out impatient participants. The sideways chop and the uncertainty conspire to make people second-guess themselves, sell at exactly the wrong time, and then watch from the sidelines as the market does what the fundamentals suggested it would do all along. The antidote is having a clear framework and clear rules that don't depend on short-term price movements to validate your thinking. If you're patient, if you understand the structural picture, then this consolidation phase is not something to fear. It's something to use. It's where the foundation of serious, long-term positions gets built quietly, while most people aren't watching. The inventory crisis in China, the backwardation, the short sellers scrambling, that's your signal that the physical market is already under stress, even while prices consolidate. Physical market stress has a habit of eventually finding its way into the paper price. And when it does, it tends to move fast. Keep a close eye on what happens with Chinese warehouse inventories. If those levels continue to fall, it tells you the supply crunch is persistent and not self-correcting. Watch whether backwardation in Chinese silver futures continues or intensifies, because that's your clearest real-time signal of physical stress. Watch the Federal Reserve for any shift in tone suggesting rate cuts are moving closer to reality. Watch retail investor flows to see if the patient accumulation behavior continues or if sentiment starts to shift. And watch options market positioning for any meaningful change in the call to put ratio, because that's your window into how institutional money is thinking about the near-term outlook. These are the real signals. Not the day-to-day price wiggles, not the breathless headlines, but the underlying structural data that tells you what's actually happening in the physical market and how informed participants are positioned. Drop a comment below right now with your take on where silver goes from here. Do you think we see new all-time highs before the end of this year? Or do you think this consolidation stretches well into next year before the next move? I'm genuinely curious what this community thinks. If you're already positioned in silver, share how you're feeling right now. Are you calm? Are you adding? Are you holding steady and waiting? Your experience adds real value to everyone else watching and working through the same questions. And if this analysis was valuable to you, the single most impactful thing you can do is share it. Send it to someone you know who's interested in precious metals or who you think should be paying attention to this. A channel like Element Axis only grows through word of mouth, through people who found something genuinely useful deciding to pass it along to someone who might benefit. So if today's breakdown gave you a clearer picture of what's happening in silver, please share it. It costs you nothing, and it helps this community reach the people who need to be hearing this kind of analysis. What's happening in China right now is not a minor footnote in the silver story. It is the silver story. The inventory crisis, the backwardation, the short sellers scrambling, these are all symptoms of a physical market under real structural strain. Paper prices can diverge from physical reality for a while, but not indefinitely. The laws of supply and demand are patient, but they are relentless. And when the paper market finally catches up with what the physical market is already telling you, those who were positioned and patient will look back on this consolidation phase and see it for exactly what it is, the setup, the quiet before the move that everybody else is going to be talking about after the fact, wishing they had been paying attention. We're paying attention, and that's exactly what being here is all about.